Hello, Lydia. How you doing? You're mute.
Okay, hi.
There we go. Now we got the test going. Now I can hear you. How you doing? You keeping up with things?
Oh yeah, I actually have some computer issues, but other than that, everything's good.
I probably can't help you with the computer issues.
Yeah, it's some weird glitch thing, but I'm getting it figured out. So last week was a little rough, but we're getting through it.
Excellent. Where are you located?
I'm in Santa Barbara.
You're local, okay.
Yeah. What about you?
I am local.
Oh, okay.
I live on the Mesa.
Oh, I love Mesa. I used to live there too. The best. So this is like, I'm just trying to see. So you do like a lecture, correct? For like chapter 2, this will be?
Pardon me?
This will be chapter 2's lecture?
I believe so, yeah.
That's
what I've prepared.
Okay, good.
So we'll wait a few more minutes, see what kind of crowd we get.
Okay. I work, so I usually work at this time, so I don't know if I'll be able to do every lecture, but I'm going to try because I'm an in-person kind of person, so it helps me.
Okay.
Retain.
Not quite 9 o'clock, so we'll give people a little, another couple of minutes.
Okay.
To show up here. Is this the only class you're taking, Lydia?
Yeah.
It's enough,
I work like 40 plus hours a week, so this is all I can do right now.
Where are you working?
I work for a construction company in Santa Barbara. Yeah. We do like high-end custom homes, but they're like, like 3 years, 2 years, big projects.
Wow. 3 years to build a house?
It's crazy. Usually we try to get it done in a year, but then they want to change things. And so it's about 2 years with the big ones.
So you don't have too many poor clients, do you?
No, they're out of this world.
You build any for celebrities?
There's high profile people.
Yeah,
For
I'm
sure.
sure you are.
Yeah. It's crazy how much money these people have.
I always thought I was fairly well off till I moved to Santa Barbara.
Yeah.
How poor I really am.
That's pretty funny. A lot of people say, like, my family say, like, they're like, we're lucky to live here because we probably wouldn't be able to afford to vacation here.
Yeah, I just had family come out here from New Jersey. And,
Oh, cool.
yeah, I said, hi,
Hey, how are you?
who could this be,
Nice
Jag?
to see you. It's Kristen.
Kristen, hold on here. Say hello to Lydia.
Hey. Hi, Lydia.
One of our teachers, Kristen.
I teach business management. How you doing?
Oh, great. I'm well. How are you?
Good. I just came to grab a pen.
Oh,
I
sure.
seem to have ended up without a pen.
Well, I can help you with that.
Hopefully. Oh, are you sure?
Yeah, go
Okay.
for it.
And then what about, do you know if there's any of those whiteboard markers in here? Because there's none in my.
Yeah,
room.
the only place I know where there's some is up in 302 up on top.
Just, no. Just to have a pack, but I don't know
Yeah.
where. I'm sorry to interrupt.
That's
you.
okay.
Okay. Oh,
If you
I'll
need
make
more,
you- I have a black one, so I'll make
Okay.
you.
yeah, did you check the tutoring room?
Upstairs.
Right here, right across, right there.
Oh, yeah.
Take whatever markers you might find there. Okay, all right. Here's Kate. Hi, Kate.
Hi.
Hey, I guess we're ready to get started with just the two of us, huh?
Okay.
That's fine with me.
All right. We're gonna go into chapter 2, and we're gonna obsess about something called the accounting equation, okay? So let me share the screen with you. Oh, hi, Kate, there's Kate. You can both see the screen now?
Yes.
Yes.
Okay. What we're gonna do is we're gonna talk about the accounting equation, which you must know like the back of your hand, right? Assets equal liabilities plus equity. Assets equal liabilities plus equity. And then we're gonna look at a bunch of transactions and see how it impacts the accounting equation. So let's see what we have here. Define the accounting elements, huh? A business entity, any individual or organization that engages in economic activities controlling specific resources. I don't think you have to worry about this slide, really. Here's an important point. The business entity's finances are kept separate from the owners. And what we're talking about is with a small business where the owner comes out and he takes money out for his own purposes. That's not a business expense. And we're going to get into that as we go along here. It's called the drawing, a withdrawal. Owner of a business may have business assets as well as non-business, we were just talking about. And non-business assets not included. And this could be a real problem when an owner is constantly mixing his own personal goods in with the company. Okay, the first part of our equation, assets. An asset, anything of value that we own, huh? We're not renting it, we own it. Doesn't have to be paid off though. We might still be making payments for the next 3 years. We might have bought a $1 million machine for our factory, and that might come with a 10-year note. Well, we own it, even though we're paying the note off. That is an example of an asset. Cash, merchandise, that's your inventory. Merchandise is what you buy and sell, huh? So we have cash. We'll let Melanie get in here in a moment. She's coming in at a good time. Anyway, assets, cash, merchandise, furniture, fixtures, a lot of different things. Hi, Melanie. How you doing? Melanie's muted. Melanie's out of touch. Okay. Assets. Let's talk about one of our assets. Accounts receivable. That's the amount of money that is owed to you at this point in time by its customers as a result of selling something on credit. If I told you that my accounts receivable total $100,000, that means that at that exact moment in time, all of my customers combined owe me that money. So accounts receivable are customer monies owed to you. You've sold your product and now they're going to pay you later. Liabilities. A liability. That's a debt. That's an obligation. It's an IOU. A liability is what you owe somebody. Typically called a payable. Whenever you see the word payable, you know it's a liability. So just like we have accounts receivable, I told you that my accounts receivable were $100,000. Maybe you're my customers, and to you, that same number is your accounts payable. So it's easy to mix up accounts receivable and accounts payable if you go too quickly. So let's try to keep them separate. Accounts receivable, accounts payable. Just excuse me 1 second. There we go. Close the door. Accounts payable. Notice it says an unwritten promise to pay a supplier. That is exactly what it is. It is an unpaid item. It's money that we owe to somebody else, and it's an unwritten promise. This is not like a note where you're signing off that you're going to pay $1,000 back that you borrowed plus interest. There's no interest with accounts payable. Everything is done on faith, on goodwill, on faith. You have a relationship with your supplier, you order from him, and he trusts that you're going to pay him, okay? And again, don't confuse accounts receivable or accounts payable. Are we waiting to receive or waiting to pay? Notes payable is another liability. Notes payable. A note payable is a very formal instrument. I wish they gave us an example here, but it's a document. And that document says, I, Bob, promise to pay Kate $10,000 back. I'll pay you back in 3 years. And each year I'm going to pay you 10% interest or $1,000 a year. That is a written formal promise. That's not accounts payable. We call that notes payable because that's really borrowing money is what you're doing there. And the one difference between notes payable and accounts payable is notes payable have a hierarchy over accounts payable. If the company went bad and they're liquidating, meaning they have to turn everything into cash, people holding a note will get paid before accounts payable people. Notes payable is what's called a secured debt. You have a little bit of collateral. Accounts payable are totally unsecured. And then owner's equity. This is the amount simply by which the assets exceed the business liabilities. And it's called a lot of different things. It's called capital. It's called equity. It's called stockholders' equity, the net worth of the business. You have a company and it has $1 million in cash and it has $300,000 in liability. On paper, that company is worth $700,000. Now, does that mean that's what it's worth in the marketplace? The answer is no, absolutely not. That's what it's worth, though, accounting-wise, $700,000. Skip through this here. Construct the accounting equation. There it is. You're seeing it in writing for the first time, huh? Assets equal liabilities plus equity. Assets equal liabilities plus equity. And this equation must always, always remain in balance. So the assets are on the left side and the right side, the liabilities and equity. So here's a little example here. If a company had business assets of $60,400 and liabilities of $5,400, what's the equity? Well, once the debts are paid, the remaining assets belong to the owner. So 60,400 minus 5,400 is $55,000. Here's your accounting equation. Assets, 64,000 plus the liabilities plus the equity equals 60,400. They're just showing it as a minus out to go to equity because they were actually going to calculate that. Always in balance. Let's look at some transactions. And in chapter 2, we're going to go through about 20 transactions, and we're going to see the effect on the accounting equation. We're going to talk in terms of using normal idiomatic English. We're going to say increase, decrease, plus, minus, up, down. Chapter 3 is where it gets a little harder when we get into debits and credits. So let's see what we have here. A business transaction, any economic event that affects the business. And it's typically with an outside entity, but there are some that are internal. And you better be able to measure it in dollars or you can't do anything with it. And all transactions affect the accounting equation, one way or another. Let's talk about accounts, an account. A separate record used to summarize changes in each asset, liability, and equity. An account. Think of it as a folder. Let's see, we're starting a business. What do we want to trace? Well, we know we want to have one for cash, accounts receivable, accounts payable. We certainly need one for, at least one for equity. We need one for rent expense. We need one for telephone expense. We need one for inventory. So you get the idea that an account is really a folder. Think of it as a folder in your general ledger. So in analyzing business transactions, they're asking 3 questions that we should be posing. 3 questions. What happened? Make sure you understand what's just taken place. That can be as simple as the electric bill came in today's mail. You opened up the mail and you said, oh, here's the electric bill. That's a transaction that needs to be processed. So you know what happened, you got the electric bill. And electricity is going to be an expense. So you know you're going to have an expense go up and you're going to pay it now. You're a nice guy. So your cash is going to go down, okay? What accounts are affected? Cash, and in this case, rent expense. And that will keep the accounting equation in balance. So show the effect of some transactions. The leading up to is 1, 2, ta-da. Okay, here's our first transaction. Mitchell Williams, the owner, he invested $5,000 in a new business. Well, what happened? He took $5,000 out of his own bank account and he put it into a business bank account. And he's calling it Mitchell Williams Delivery Service or something. Mitchell Williams Capital. So what accounts are affected? And by the way, you always have 2 accounts minimum in a transaction. You always have 2 accounts. That's why it's called double entry accounting. So identify the accounts that are affected. Well, his cash, did the cash go up or down? The cash went up. He didn't have a business before. Now he's got $5,000. What happened to his capital? Well, the business is now worth $5,000. And they're going through a big screen here. Identify these accounts as assets or equity. So cash is going to be increased. Cash is going to be increased. And capital is going to be increased. Let's look at the transaction. And there you go. How about that, huh? Your first transaction. Cash is now $5,000. His capital is $5,000. So far, he's only hit 2 accounts. Let's see what the next one is. Hey, he bought something for cash. He bought an asset. What did he buy? He bought delivery equipment for $2,000 cash. Okay, so what are the accounts that are affected? Well, he bought equipment, so equipment would probably be one, and he's paying it off right now. So that means cash. And they're both assets. So we're just exchanging one asset for another, really. So cash is going to be decreased. The delivery equipment is going to be increased. And let's take a look at it. You see it over here? Your cash was 5, it's now 3. Your delivery equipment went up to 2 because we bought that asset. We exchanged one asset for another, and our equity is still the same as the assets and liabilities, okay? Now he bought an asset on account. As soon as you see on account, I tell people, say to yourself, on account and nobody had cash. As soon as you see on account, you know there is no cash involved in the transaction. It's going to be accounts payable or accounts receivable. So Mitch bought delivery equipment for $1,800 on account. Let's see, no cash was exchanged. We know that. So what's going to change? Well, his delivery equipment, he bought more equipment, that's going to go up. And what else is going to go up? We know it's going to be, when you see on account, we know it's either accounts payable or accounts receivable. Here, it's clearly accounts payable because we're going to have to pay that in the future. Okay? So his equipment went up and so did the liability. Take a look here. We had delivery equipment of 2,000. Now we added 1,800. Now we have assets of 6,800. We started with 5, if you remember. And now we added to the equity here 1,800 in liabilities. This is a debt to be paid, probably in 30 days. And now he's making a payment of 1/3. It's not really a loan, but we'll pretend it is. He's making a payment now. So he's paying for this debt here. This debt is now going to be reduced by $600. And the cash is going to come down by $600. What accounts are affected? Cash and accounts payable, both going down, down, down. So let's take a peek. You got a good look at that there? Cash is now down to 2,400 plus 3,800 is 6,200. And we're in business here tied in 12 and 5,000 equals 6,200. Okay. Not too bad. Not too bad. Question?
Yeah. Why is the 1,800 out of the assets now? Is it because he made his first payment towards that?
That's exact. Yes. That's what transaction D is.
Number, even though it's not fully been paid off,
We're just paying off part of it.
but you still wouldn't keep it under delivery equipment anymore, or the assets, because you started to pay towards it.
We already recorded the asset when we bought the equipment. The equipment is the asset.
Yeah.
We bought that. Now we have to pay for it. And we owed him 1,800. We're only making a payment of 600 though.
But the 1,800, why did you put it under assets in the beginning?
So, the 1,800 is not under assets, it's under liabilities.
But in the, like a couple of slides ago, it was under the delivery equipment.
The delivery equipment is the asset.
Mm-hmm.
You bought an asset on account and nobody had money. So your asset goes up.
I see.
And now this is a debt. The
Okay.
debt went up, 1,800. Now it's 30 days later, perhaps, and we're making a partial payment.
Okay.
So the delivery equipment doesn't change. That's from 0 already.
Yeah.
So now the cash goes down, and so does the accounts payable. Now we only owe 1,200.
I get that. I was just curious why the liability was in the assets column to begin with. But
Yeah.
that makes sense.
Okay.
Thank you.
Let's talk about revenues and expenses, huh? Revenues, those are your sales. That's what you charge people. In this course here, we're going to be a small business, and we might have things like delivery fees, consulting fees, rent revenue, interest revenue, and we're gonna do some selling too, later in the class. Some, when we pretend we're Nordstrom's or somebody, okay? So what's revenue? Those are sales. When revenue goes up, equity goes up. When revenue goes up, equity goes up. Expenses are the offsets to your sales. Expenses, rent, salaries, supplies, taxes, all kinds of things, insurance, labor, indirect labor, all kinds of things. Maintenance, you can think of a million expenses. Whenever an expense is recorded, your equity goes down. Your equity goes down. Your revenue minus your expenses, that's going to be your profit. So hopefully the revenues will always exceed the expenses, okay? And you're going to have a separate folder, if you will, a separate account for each type of expense. And they're giving you some examples here. This is an accounting concept I don't think is on the test. But what they're saying is there's an accounting concept. I mentioned GAAP, right, in the first chapter, generally accepted accounting principles. One of them is called periodicity. It's a fancy word for saying that any business theoretically can be broken out into a finite amount of time, typically a month. Businesses close every month, do their financial statements. Any accounting period of 12 months is called a fiscal year. Does your company do that, Lydia?
Say that again, sorry.
Does your company close the financial statements every month?
Yeah, we do the end of month recording, yes.
That's quite normal. That's what everybody does. Well, I don't think you had to go to college to understand this slide, huh? Revenues are 9,000, expenses are 5, we have income. When the expenses are higher, we have a net loss. And believe me, I've been with companies that have shown net losses. Now, here we go with the personal business of the owner we talked about earlier. When an owner takes resources out of the company, that's called a withdrawal. A withdrawal or drawing. What it does, it reduces the owner's equity and assets. It's not an expense. Withdrawals are not an expense. It's a reduction in the company's equity. If the boss comes out and takes $5,000 out, that company is now worth $5,000 less than it did before that check was written. Let's look at our expanded accounting equation, okay? And this is everything. This is everything right here. Assets equal liabilities plus equity. We know that, right? What are the components of equity, though? Equity consists of capital, less any drawings that may come out, plus the revenues minus expenses. Another way to say it is your owner's equity is your capital minus the drawings plus your profit. Okay? The accounting equation is expanded to include revenues, expenses, and withdrawals. Revenues increase owner's equity, expenses decrease them, otherwise known as your profit. Here we go. Mitchell delivered some pizzas for cash. He did some work. He actually generated some sales. And those were cash deliveries. So what's going to happen here? Cash is going to go up by 2,100, right? So are the revenues. They will also go up by $2,100. Let's take a look. Revenue, 2,100. And notice what that did to your overall equity. It increased it from 62 to 83, and we're still in agreement. Assets equals liabilities plus equity, okay? This was a sale. His sales went up 2,100, and it was a cash sale. Those are the kinds we like. Uh-oh, but he's got expenses too, huh? Too bad. He rents an office for $1,000 a month. So what happened? He paid the rent bill. Well, that certainly means cash is gonna go down. Whenever you see the word paid, it means cash goes out the window. And what's gonna go up? Rent expense. So cash went down and the expense went up. The effect on your equity is a decrease of $1,000. See it right there? Minus $1,000. And we're still in here. You still with me, everybody? Let me
Mhm.
know if you think I'm going too fast. I
Good.
tend to get into that New Jersey, BS style of talking too quickly. So you know what I mean, huh? Paid the phone bill. Same exact transaction. He paid the phone bill. The cash is gonna go down and the phone expense is gonna go up. It's gonna decrease the equity. Owner's equity is gonna come down by 100. We just gave away an asset. So the cash goes down to 3,400. The expenses go up by 100. So far, this guy has revenues of $2,100 and expenses of $1,100. If the month ended right now, he'd have a profit of $1,000, okay? Now, he delivered some goods, but he did it on account. He did it on account, and nobody had money. He performed delivery services, 2,400. He catered a big faculty meeting here. And he brought in all these pizzas, $2,400, and he handed me a bill. And I'm gonna pay the bill in 30 days, okay? So Mitch, who we're talking about, he has now earned more revenues and he's not getting cash. He's getting a promise to pay though, right? Which is what accounts payable is. So let's take a look. Revenues go up by 2,400 and so does accounts receivable. You understand that, Lydia?
Kind of. So he like hosted something? I forget like the whole story of him. What is he paying?
Provided a service on account, meaning.
Oh,
that
okay.
he's
So
gonna get paid
he did a
later.
delivery service for someone.
No
Okay.
cash yet, huh?
Okay.
So it's revenues 2,400 going up and accounts receivable goes up. That
Got it.
2,400 hopefully is gonna be paid into cash in the near future, right?
Yes.
Okay.
That makes sense.
Purchase of supplies. He bought supplies for $80 cash. But these supplies are going to last a couple of months. So when you buy supplies, they're considered an asset, believe it or not. Okay? When you buy supplies, they're considered an asset. They're
Interesting.
not an expense until when? When you use the supplies.
Oh, so when you have to buy more?
What's that?
When you buy more, or that's just when they're
When you buy the supplies, you're gonna put it into an account called supplies, which is an asset.
Mhm.
Then at the end of the month, you're gonna go out and count the supplies. You went out and counted at the end of the month, they only had $20 worth left. Now you know they used 60. That's when you record the expense.
got it.
Record the expense when you incur using the asset. So what's gonna go up? An asset called supplies. And since we paid cash, cash is gonna go down. And now look how long our equation's getting, huh? We got all kinds of good stuff in here. We have cash, receivables, supplies, prepaid supplies, delivery equipment. They total $9,600, and that's equal to our liabilities of $1,200. We still owe $1,200 for that delivery equipment. We have the $5,000 in cash that Mitchell put into the business, and we add in the revenues and subtract the expenses. Supplies is a prepaid expense, since the supplies will be charged off as expenses when they're consumed, when we use them. Cash receipt from prior sale. Well, he just had a sale on account, right? for $2,400. See that 2,400, Lydia? Now, this customer, or whoever that customer is gonna pay us. And they're paying us $1,900. So what's gonna change? Cash is gonna go up, but accounts receivable is gonna go down because the guy does not owe us 1,900 anymore. He only owes us 500 now. Take a peek. Accounts receivable, we sold it to him for $2,400 to be paid later. Now he's paying us, so the cash goes up and the receivable goes down. Another exchange of assets, if you want to call it that, okay? Uh-oh, now we got a triple one. We got three accounts to worry about. Mitchell bought a scooter for $1,000. He paid $300 cash, and he's gonna pay the rest over the next few months. This affects three accounts, doesn't it? 1, 2, 3. Well, let's think about it. Delivery equipment, that's gonna go up by $1,000. When you agree, delivery equipment? Cash is going down by 300. Cash is going down by 300. And that leaves $700 of a liability that we owe. What do you think, Lydia? Makes sense?
Yeah.
So let's take a look at the posting. We bought equipment for $1,000. We paid $300 for it as a down payment. The remaining $700 represents an increase to accounts payable. So now we're still in gear. Uh-oh, we bought insurance. When you buy insurance, it is by definition an asset. It is an asset until you get the benefit of it, okay? You suppose your company bought an insurance policy December 28th at the end of the year, right? And that policy covers you for the next year. Well, in December, when you bought the policy, you don't have any coverage yet. That's an asset, that policy. In the end of January, you're going to record 1/12 of its value and do that month after month after month, okay? So prepaid insurance, that's going to go up and cash is going to go down. So we added another account here, prepaid insurance and cash going down to $42.20. Okay, we're up to Emma. Uh-oh, he's got another expense. Got to pay those wages, huh? What happened? Well, he paid his employees, his delivery guys. Identify the accounts that are affected. Cash and wages expense. And they're reminding us that expenses decrease owner's equity. And does our equation still balance? Oh, yes. Oh, yes. Cash goes down $1,650, but look, his expenses more than doubled, huh? Went from 1,100 to 27. He's still profitable though. He's got sales of 4,500 against 2,750. LM. Here's another 3-line one, huh? Before we had a purchase where we made a down payment, right? Now we're selling something and our customer is making a down payment with the rest to be paid later. So we've got 3 things to worry about. We have the deliveries, 3,500. That's your revenue. We're going to receive 900 in cash, and we'll put the rest in accounts receivable. Cash goes up by 900. Delivery fees go up by 3,500. And the difference of 2,600 is money that our customer owes us later. So here we go, 2,600. We got 900 here. That's a total of $3,500 in revenues. We're still in balance. Now let's look at a withdrawal. This is personal business. Mitch comes out to the office And he says to Kate, Kate, cut me a check for $5,000, please, payable to me. And you say, yeah, no problem, boss. What's it for? You need to know that, right, in order to record it. And the boss says, I'm going to Las Vegas over the weekend with some friends. Well, at that point, you know it's not a business transaction. It's a drawing. So you have to record it as such. It's not an expense. It's a reduction in equity. So what's going down? The equity is going down, and it's going down through the drawing account, and cash is going down. Cash is going down. And here's a look at it here. See, they squeezed in the drawing. They're showing a plus with the drawing only because they're talking up and down. But that's a reduction. This 3,000 is a reduction in capital. See the formula? Capital minus drawing plus revenues minus expenses. Drawing went up 3,000, no good, reduced equity. Cash went down. And I think that's the last transaction before we get into some ancillary area here. So let's see what we have. Now, here is the end of the month. The month has just ended. This is how much money we have in the bank, 470. How much our customer owes us, 1,800. That's how much we owe to people, okay? We're ready to now prepare the financial statements. And we're going to look at a very simple income statement, statement of owner's equity, and balance sheet. These are the three basic financial statements that all companies produce, okay? They also produce a cash flow statement, which we're not going to worry about just yet. So they must be done in this order: income statement first, then the equity statement, then the balance sheet. You cannot do them in any other order. And I'd like you to understand why. That'll help you how to put these reports together. Three statements: income statement, equity statement, balance sheet. And then they talk about the headings. I'm not going to worry about where you put double lines and things, okay? Okay, look at your income statement. Let's take a peek at it, huh? Take a peek at it. Delivery fees were $8,000. Expenses were $1,650 for wages, $1,000 for rent, and $100 for phone. You add up your expenses and put the total there. Revenues minus expenses equals net income or net profit. Okay? Where did we get these numbers? Where did we get these numbers? Where did we get that 8,000 and the 2,750? We got them right from here. We got them right from here. There's your 8,000. There's your 2,750. And the 2,750 was broken out into wages expense, you remember? 1,650, rent and phone expense. So the income statement on a very simple basis is just your sales minus your expenses. Revenues minus expenses equals net income. Now, here is why you must do the income statement first, because we need this net income number. We need this net income number to bring it over to the equity statement. So let's look at our equity statement. Equity. What was the beginning equity? Well, he put 5,000 in the business. I'm going to call that the beginning, okay? This was his equity on June 1st, okay? June 1st, he began with $5,000. We're going to add the net income. We couldn't get that net income until we did this statement, the income statement. So we're going to add the net income and subtract any drawings, because drawings reduce. Drawings reduce capital. So let's see here. he had an investment of 5,000, but then he had income of 5,250, and he had a decrease of 3. That gives him capital at the end of 7,250. Looks like he had a pretty good month, huh? He was able to pay himself $3,000, and he grew the company 7,250. Let's just divide that out just for the heck of it. $7,250 divided by 5,000, his beginning. So he grew the company by 45% in 1 month. That seems pretty darn good, huh? So what was the equity on June 1st? 5,000. What is it at the end of the month? 7,250. Note the heading here. Notice this heading says for the month ended June 30th. Notice this heading says the same thing. For the month ended, or for the month of, something like that, or month of June. The next statement is the balance sheet, and you're going to see a different heading. Notice it just shows the date. It does not say for the month ended. It is a date. It needs to say as of June 30th, because the balance sheet is a snapshot. It's a photograph of all of your balances at the end of the month. Okay? It's a snapshot of all the accounts at the end of the month. So let's see what we have here. Cash 470, accounts receivable 3,100, total assets 9,150. Where did we get those numbers? We got them right from here, right from our trial balance. 9,150, 470, 3,100. There's your 1,900 in payables. And there's the capital number, 5,000 minus 3 minus plus 8 minus 1,250. Income statement you do first. You need the income to impact the owner's equity statement, and then the balance sheet. The balance sheet is a presentation, if you will, of the accounting equation. Assets on one side of the page or on top and the others on the bottom. Your assets total 9,100. We bring over the accounts payable. And now we're not going to bring over the 5,000 at the beginning. What was it at the end? It was 7,250. We add that up to the accounts payable, and our balance sheet is in balance. And these are the 3 statements that every company looks at. If you're Microsoft, doing the same exact thing. Let's see the income statement. Let's see the equity. Let's look at the balance sheet. If you're a small business, I guess you really look at them closely, huh? You're not going to be able to borrow money from a bank unless you have good audited financial statements. No one's going to loan you money. No one's going to sell to you on credit if you don't have good financial statements. So these things are the lifeblood of the company, okay? The lifeblood. You ready for the 3 basic phases of accounting? And this makes me laugh. Input, processing, output. IPO. Input. Business transactions provide the input. Processing is recognizing what's going on, how to record them. And then the output is the financial statements. The only reason I present this slide is this has been a question on the test. What are the 3 basic phases of accounting? Input, processing, output, okay? And with that, we've come to the end of our presentation, okay? Does anybody have any questions, anything they'd like to review?
I have a question, Bob. Yes, back in slide, this is going back a ways, back in slide 44, you were like, oh, if Mitch ended his month right now, he would make $1,000 in profit. I think that's what you said. And I just was wondering if you could talk through that really quickly.
Slide 44?
Yeah. G, transaction G.
Yeah. Well, very simple. His revenues were $2,100 at that point, right?
Okay, right.
And his expenses totaled 1,100 at that point.
Okay, so it's just rate. That's where we look at it over there.
So at that
Okay.
point in time, his profit was $1,000.
Okay.
But you don't record the
Okay.
profit in the middle of the month. I mean, you're interested in what it might be. But that makes sense?
Okay. Yes, thank you.
Okay. Question, Melanie? Is Melanie out there? Hello, Melanie. Melanie's hiding.
I am here. Sorry, I was just listening and checked out. I'm gonna go review it again. So if you asked me a question, I missed it because my husband was right outside the door.
Oh, he's giving you a hard time, huh?
No.
No, I was asking you. You have any questions or anything as we finish up?
No, I mean, the explanation sounded clear, but I want to again review the lecture and then write appropriate notes. So,
Yeah, once you just start doing the homework, it'll really click in, I'm sure.
right.
Next week's gonna be the tougher challenge when we change the words increase, decrease to debit and credit.
Mhm.
You have to understand the rules of debits and credits.
I think like I work with debits and credits a lot, but I do very basic like bookkeeping stuff here, and I work mostly on like our clients' budgets, project budgets, but I also oversee things, so I'm just that's why I'm taking the class, because I want to know more of why I'm doing things and what they actually mean.
That'll be a good- Yeah, that's a good head start.
So it's like I know these equations, they look something, we use a software, but I do debits and credits and accounts payable and stuff like that, but
Okay.
this is like breaking everything down, so it's definitely a little bit more than I'm used to, but it's interesting, and it's
Okay.
making sense a little bit, but
Okay.
I do half of what this is, I don't go into all these details.
Yeah, ask the accounting guys and women at work about debits and credits.
Yeah. It's
If
a
you
lot
went
of
up to your
information.
controller or one of the accounting people and say, hey, next week, I'm gonna learn about debits and credits. Should I be worried? They'll probably tease you a little bit and say, oh, yes.
Well,
Because that's the language.
yeah,
But
we
we'll
also
get-
have like an accountant. We have like a bunch of different people that do parts of it, but
Mhm.
yeah, this is interesting.
Yeah, no, that's good. Okay, with that, we'll turn the meeting closed, okay?
Okay, thank you so much.
All right, thanks, everybody, for stopping in.
Yes, thank you, Bob. Bye.
Yeah, bye-bye.
Bye.